Let's jump right in. Today's market is caught in an absolute crossfire. We're looking at a violent collision between massive global tech shifts and some seriously heavy macroeconomic pressures. So we're going to move fast today, breaking down exactly what caused this sudden tech sell-off, and more importantly, where all that smart money is rotating right now. Let's get into the numbers. Starting off the scorecard, the KOSPI closed down 0.6% today at 6,258.77. Now, I know 0.6% doesn't exactly sound like some catastrophic plunge, right? But do not let that surface number fool you. Underneath that slight dip is an incredibly volatile reallocation of wealth. Large cap tech took a massive beating today, dragging the broader index down with it and completely masking the crazy strength we saw bubbling up in other sectors. You can really see this playing out on the daily index chart. We had a short-term price retracement attempting to stabilize things after yesterday's much more aggressive decline. The market actually opened a bit higher, totally trying to catch its breath. But that early momentum, it just couldn't hold up against the sheer weight of institutional selling. The bears absolutely took control as the day went on. And a lot of that downward pressure is coming straight from the macro environment. Oil prices are a huge pressure point for global equities right now, with WTI crude ticking up to $78.02 a barrel. For a heavily manufacturing and export-driven economy like South Korea, that is not just a number on a screen. Honestly, every single time energy costs tick up, corporate profit margins get instantly squeezed. Meanwhile, the dollar index is standing strong at 99.9. Think of a strong dollar like financial gravity for emerging markets. As the dollar stays elevated, reflecting all those broader currency and inflation pressures, foreign capital naturally pulls back to safety. It shifts entirely away from emerging markets, and that is exactly the dynamic we are seeing play out on the trading floor right now. The reality of today's market is honestly pretty stark. If you just glance at the sector heat map, it tells you the whole story. We've got this massive concentrated sea of red in memory tech, and it's directly funding a bright green surge in batteries and component stocks. It's a rapid, massive reallocation of capital. So let's break down exactly what triggered this huge red wave. Okay, so the actual catalyst for the tech drop started yesterday with what we're basically calling the SanDisk shock. They put out an unexpectedly weak revenue outlook, and it sparked immediate panic over global NAND demand. The flash memory used in basically all our everyday electronics. Because local tech giants are huge players in the NAND and enterprise SSD space, that fear instantly bled into the broader market and rapidly reset revenue expectations across the board. This shock triggered a high-stakes, absolute tug-of-war. On one side, foreign investors were aggressively dumping their large-cap memory stocks, just totally slashing their exposure to perceived demand risks. But on the exact opposite side, individual retail investors stepped in with massive volume, aggressively buying the dip. They absorbed literal billions in sell orders, which kept the market from totally collapsing, but man, that foreign exodus was heavy. Then, the selling pressure accelerated even more today because of a critical semi-analysis report. It suggested NVIDIA might slash its upcoming Rubin Ultra HBM memory configuration from 12 layers down to 8. This is huge. High-bandwidth memory is literally the golden goose of the AI boom right now. If NVIDIA slashes this requirement, total projected demand for 2027 takes a massive hit. And that is exactly what sparked today's panic. Let's look at how this impacts specific companies. Because SK Hynix supplies about 70% of NVIDIA's volume and relies really heavily on its competitive edge in high-layer stacking technology, Hynix took a much harder 4.8% hit today compared to Samsung's slight gain. Why the difference? Well, Samsung produces the logic-based die in-house, which gives them way better cost control and a really crucial protective buffer against these exact kinds of supply chain shocks. And just how concentrated was this foreign exit? It was incredibly surgical. Breaking it down, we saw massive net selling concentrated almost entirely in these tech giants. Foreign investors dumped hundreds of billions of won, and just 3 specific assets, Samsung Electronics, Samsung Preferred, and SK Hynix, accounted for a staggering 62.2% of all foreign net selling today. That is what you call a targeted sell-off. But here's the thing. That capital didn't just disappear into thin air. Institutional buyers acted incredibly fast. They rapidly rotated their money right out of memory chips and aggressively deployed it into semiconductor components, chemicals, and the battery sector. This is a classic textbook sector rotation, taking funds from a highly vulnerable area and dumping them directly into one with locked-in structural growth. The biggest winner in this aggressive rotation was POSCO Future M.
They just announced a massive long-term supply plan to deliver 190,000 tons of LFP cathode material for energy storage systems between 2026 and 2032. This is not speculative AI trading based on tomorrow's hype, okay? This is locked-in, long-term structural demand, and it is completely capturing the market's attention right now.
This kind of corporate win is grounded at massive tech facilities like Samsung Digital City. Samsung SDI is actually expanding its U.S. production and energy storage system sales to meet the skyrocketing energy demands of AI data centers. Think about it for a second. The AI boom requires extreme power stabilization. That means batteries aren't just for electric vehicles anymore. They are literally the backbone of our AI infrastructure. LG Energy Solution is catching this exact same wave, aggressively expanding its North American ESS order volume to 90 gigawatt hours. And how are they pulling this off? By intelligently converting their existing underutilized EV battery production lines directly into energy storage system equipment. It's a totally brilliant operational pivot, and it pulled in major institutional money today. But no matter how brilliantly specific companies pivot, they cannot outrun global macro risks. Zooming out from these corporate wins, we have to look at the Middle East. Right now, Iran and Oman are actively negotiating a 3 to 7% transit fee for cargo passing through the Strait of Hormuz. When you combine that with potential vessel bans, it is a massive red flag for global shipping costs and global supply chains. And this creates a highly dangerous chain reaction for your portfolio. Hormuz tensions don't just stay in the Middle East, right? They immediately drive up oil prices. That directly fuels sticky domestic inflation, which ultimately kills any hopes we had for near-term Federal Reserve rate cuts. It is a vicious cycle that just systematically suppresses stock valuations across the globe. This very real geopolitical risk premium is exactly why Brent crude jumped over 3% today to $82.49 a barrel. When energy inputs spike this aggressively, manufacturing margins shrink rapidly. Investors instantly demand higher returns to compensate for the underlying systemic risk. And it honestly just changes the math for everything. For the South Korean economy, centered right in financial hubs like Yeouido, these rising U.S. Treasury yields raise the equity discount rate. That drags down the large caps and pressures the entire market, even with the battery sector showing such strong resilience. Right now, it is just a constant, daily battle between top-down macroeconomic pressure and bottom-up sector innovation. The market never stops moving, and honestly, neither should your awareness of these massive capital flows. We've just seen exactly how quickly a tech sell-off can fuel a battery boom, all while under the shadow of global inflation. So the ultimate question for investors today is this. Are we just looking at a temporary tech dip, or is this the actual beginning of a massive, permanent, structural rotation? What's your next move? If you want to stay ahead of the Asian markets before New York even opens, make sure you hit subscribe. See you next time.